You're sitting in your 2019 Honda CR-V in a Starbucks parking lot at 7:42 a.m. on a Tuesday. Your phone is open to Zillow. You've been looking at the same three-bedroom ranch in a decent school district for the past 4 days. The listing says $389,000. The photos show beige carpet, white walls, and a kitchen that was updated sometime around 2008. There's a crack in the driveway. The backyard is the size of a volleyball court. You refresh the listing 3 times, watching the little heart icon like it's a countdown timer. Your household brings in $105,000 a year combined. You and your partner both have bachelor's degrees. You both have jobs with health insurance. By every traditional measure, you're doing fine. You should be able to afford this house. The mortgage calculator on the bank's website says you're pre-approved. Your real estate agent keeps texting you that homes in this price range are moving fast. Tell me if this sounds familiar. Because right now, hundreds of thousands of people are sitting in parking lots, refreshing listings, doing mental math that doesn't add up, wondering if they're missing something. Spoiler alert, you're not missing anything. The math is broken. And what nobody is telling you is that a $400,000 house in 2026 isn't the starter home it pretends to be. It's a financial stress test designed for household incomes most Americans don't have. Today, we're going to calculate who can actually afford a $400,000 house, not who qualifies for the loan, not who the bank says is approved, but who can buy this house and still sleep at night without their bank account appearing in their nightmares. Subscribe if you've ever felt like homeownership keeps moving further away no matter how hard you work. And smash that like button if you're tired of financial advice that ignores basic arithmetic. Here's the thing about $400,000 homes that most financial gurus get completely wrong. They tell you it's all about discipline. Cut back on coffee, skip the avocado toast, work a side hustle. But that advice ignores the structural reality of housing affordability in 2026. The median household income in America right now sits around $74,600. Let me say that again so it sinks in. The typical American household makes $74,600 per year, and we're asking those households to somehow afford homes that cost more than 5 times their annual income. There's a term economists use to measure this disconnect. It's called the price-to-income ratio. It was developed by housing researchers in the late 20th century as they studied historical affordability patterns across different economic cycles. The basic idea is simple. You take the median home price and divide it by the median household income. Historically, a healthy housing market sits around a ratio of 3 to 1. That means a house should cost roughly 3 times what a typical household earns in a year. In 1990, the national price-to-income ratio was 2.9, affordable, sustainable, reasonable. By 2006, right before the housing crash, it had climbed to 4.6. Economists were screaming warnings. Today, in early 2026, the national price-to-income ratio is hovering around 5.2. In markets like Denver, Austin, and anything within commuting distance of a tech hub, it's closer to 7 or 8. But here's what actually happens when you run these numbers on real people. Meet the Andersons. Sarah is a high school teacher making $58,000. Mike works in IT support making $52,000. Combined household income of $110,000. They're 32 and 34 years old, no kids yet, but planning. They have $35,000 saved for a down payment, which took them 6 years to accumulate while renting a 2-bedroom apartment for $1,850 a month. They found a house listed at $395,000 in a suburb 40 minutes from where they both work. 3 bedrooms, 2 bathrooms, built in 1998. The bones are good, but it needs some updates. The listing agent says it's priced to sell. Most people would look at the Andersons and say they're in great shape. Dual income, above the median, savings in the bank. No debt besides Sarah's $18,000 in student loans. By conventional wisdom, they should buy this house. But let's do the math that nobody wants you to do. The Andersons put down $35,000. That's 8.9% of the purchase price. Not quite 10%. Definitely not the 20% that avoids extra fees. That leaves them with a $360,000 mortgage. At current interest rates, which are sitting right around 6% for qualified buyers with good credit in February 2026, their monthly mortgage payment comes out to $2,158, just principal and interest, nothing else. But here's where it gets really interesting, because that $360,000 loan with less than 20% down triggers something called private mortgage insurance, PMI. This is the fee you pay every single month for the crime of not being wealthy enough to put down a huge chunk of cash up front. PMI typically runs between 0.5% and 1.5% of the loan amount annually, depending on your credit score and down payment size. For the Andersons, with decent credit and a 9% down payment, they're looking at roughly 0.8% annually. That's $2,880 per year. Divided by 12, that's $240 per month added to their payment. So now we're at $2,398 per month. And we still haven't touched property taxes. Property taxes in the United States vary wildly by state and county. In some areas, you're paying under 1% of your home's value annually. In states like Illinois and New Jersey, you're closer to 2%. For a $400,000 house in a typical suburban area, property taxes run somewhere between $3,600 and $6,000 per year. Let's be conservative and say $4,800 annually. That's $400 per month. We're now at $2,798 per month. Then there's homeowners insurance. This used to be a minor line item, not anymore. Climate change has made everything more expensive to insure. Hurricanes in Florida, wildfires in California, hailstorms in Texas. Even if you're in a relatively safe area, national average homeowners insurance for a $400,000 house runs around $2,400 to $3,000 annually. Let's call it $2,600. That's $217 per month. Total housing payments so far is $3,015 per month. But here's what most people forget about until the water heater dies at 11 p.m. on a Sunday: maintenance and repairs. The general rule, backed by decades of homeownership data, is to budget 1% of your home's value per year for maintenance. On a $400,000 house, that's $4,000 annually, about $333 per month that you need to be setting aside. Because roofs don't last forever, HVAC systems break, dishwashers flood, fences rot, driveways crack. Let's add it up. Mortgage payment, $2,158. PMI, $240. Property taxes, $400. Insurance, $217. Maintenance fund, $333. Total monthly housing cost is $3,348. Now here's where the brutal honesty starts. Financial advisors will tell you that you shouldn't spend more than 28% of your gross monthly income on housing. Banks will approve you if your total debt-to-income ratio is under 43%. Let's reverse engineer this. If you're spending $3,348 per month on housing, and that represents 28% of your income, you need to be making roughly $143,500 per year. If we use the more lenient 43% rule that banks actually use, you still need to be pulling in around $93,500 annually just for the housing payment to not violate underwriting standards. The Andersons make $110,000. At first glance, they clear the 43% threshold. They're approved. But let's look at what that actually means for their lives. Their gross income of $110,000 sounds solid until taxes show up. After federal taxes, state taxes, FICA, and modest 401k contributions of 5% each, they're taking home roughly $6,750 per month. That's their actual money to live on. Subtract that $3,348 housing payment, they're left with $3,402 for everything else in their lives. 2 car payments because they both commute 40 minutes, that's $720. Car insurance for 2 vehicles in a suburban area, $185. Gas because nothing is walkable and they're driving 80 minutes combined daily, $350. Sarah's student loan payment, $210. Health insurance premiums that their employers don't fully cover, $380. Groceries for two people trying to eat reasonably healthy, $650. Utilities for an 1,800 square foot house. Electricity, water, gas, internet, cell phones, $425. We're at $482 remaining for clothing, entertainment, dinners out, medical copays, gifts for weddings and birthdays, car repairs when the check engine light comes on, saving for anything beyond just surviving. That's $16 per day for two people for every single thing not already listed. And this is a household making $110,000 per year. They're in the top 35% of American earners, and they have $16 per day of financial breathing room. A 2021 study by the Federal Reserve found that 37% of Americans couldn't cover a $400 emergency expense without borrowing money or selling something. Think about that in context. The Andersons, making $110,000, have exactly $482 per month not allocated to fixed expenses. One urgent care visit with a $150 copay, one set of new tires at $800, one plumbing emergency at $600, and suddenly they're making decisions about which bill to pay late. This is what being house poor actually looks like.
It's not dramatic. It's not obvious. It's grocery store math. It's checking your account before putting gas in the car. It's saying no to your friend's weekend trip because you can't justify $300 when the HVAC might need servicing. But here's what changes everything. Let's say the Andersons get smart. They run these numbers before buying. They realize $400,000 is going to strangle them financially. So they look at $320,000 houses instead. Same interest rate, same down payment percentage. Their mortgage drops to $285,000. Monthly payment becomes $1,708. PMI drops to $190. Property taxes drop to $320. Insurance drops to $187. Maintenance to $267. Total monthly housing cost falls to $2,672. Suddenly, they have $4,078 per month after housing instead of $3,402. That's an extra $676 per month. That's $8,112 per year. That's an emergency fund. That's retirement contributions. That's actual financial security instead of performative home ownership. Most people don't do this math. They trust the bank. They trust the real estate agent. They trust the system. And the system is designed to get you into the house, not to ensure you can actually afford to live in it long term. Because every single person in that transaction has an incentive to maximize the sale price. The real estate agent's commission is a percentage of the sale price. Higher price means higher commission. The bank makes money on a 30-year mortgage regardless of whether you're financially comfortable. The insurance company makes money on your policy. The property tax assessor doesn't care if you're stretched thin. Nobody in that equation makes money when you say, "No thanks, this doesn't work for me." Here's what really gets me. Home prices have increased roughly 380% since 1990. Median household income has increased about 167% in the same period. The math doesn't work. It cannot work. It will not work. And yet we keep pretending it does. We keep telling people that home ownership is essential for building wealth, which is technically true, but ignores the part where you have to survive the mortgage first. We keep perpetuating the myth that if you just budget better, work harder, sacrifice more, you can make it happen. But you can't budget your way out of a structural affordability crisis. In markets across America right now, $400,000 is considered normal, median, starter home territory. In Denver, the median home price is $620,000. In Austin, it's $565,000. In anything within 50 miles of Seattle or San Francisco, $400,000 gets you a condo with HOA fees that cost more than some people's rent. According to data from the Census Bureau's 2024 American Community Survey, only about 18 to 22% of U.S. households earn $140,000 or more, which means roughly 80% of American households cannot comfortably afford a $400,000 home under any reasonable financial standard. This isn't opinion. This is just math being cruel. This isn't just bad luck. This isn't you being irresponsible with money.
This is a housing market that is completely disconnected from income reality and a financial system that profits from that disconnection. Let me be very clear about something. The system is designed to approve you for mortgages you can technically make payments on but can't actually afford to live with. Banks don't care if you're house poor. They care if you make the minimum payment every month for 30 years. That's a feature, not a bug. Real estate agents depend on closing deals. Their entire income model requires you to buy the most expensive house you qualify for, not the house you can comfortably afford. Mortgage brokers get paid when loans close. Insurance companies profit from higher coverage amounts. Every single incentive in the home buying process pushes you toward the edge of your affordability, and then 1 inch past it. They budget for you being stretched thin. They depend on you not doing this math. They rely on you trusting the process instead of trusting the numbers. Here's what really frustrates me about this. We've normalized financial desperation and rebranded it as adulting. Oh, you're house poor? Welcome to homeownership. Can't afford furniture for 3 of your bedrooms? That's just part of the journey. Eating instant ramen for dinner because all your money went to the mortgage? You're building equity. It's like we've collectively agreed to pretend that struggling to afford basic homeownership is somehow a rite of passage rather than a symptom of a broken system. The math is screaming at you, but culture keeps whispering that you should buy anyway. Your parents bought a house at your age. Never mind that their house cost 2.9 times their annual income and yours cost 5.4 times yours. Your friends are buying. Never mind that you have no idea what their actual financial situation looks like behind their freshly painted front door. Society tells you that renting is throwing money away. Never mind that being unable to afford your mortgage is also throwing money away, just with extra steps and foreclosure risk. In 5 years, households that stretch to buy $400,000 homes on $95,000 incomes will be one unexpected expense away from disaster at all times. One job loss, one medical emergency, one major home repair, and their entire financial life collapses. Meanwhile, households that waited, saved more, or bought less house will have emergency funds, retirement contributions, and the ability to handle life's inevitable curveballs. The gap between those two groups widens every single year. This is where I get genuinely frustrated, because this isn't about personal failure. The system is failing you, and it's doing it by design.
So what do you actually do with this information? The answer is not give up on homeownership forever. The answer is to ruthlessly prioritize financial reality over social pressure. Let me give you some strategies that actually work. Strategy 1. The reverse budget method. Most people figure out what house they can afford by asking what the bank will approve them for. Flip that entirely. Start with your actual take-home pay after taxes. Subtract all your fixed expenses: car payments, insurance, student loans, groceries, utilities, everything you know you'll spend. Whatever's left is your maximum housing budget, not the bank's number, yours. For a household making $110,000, that might mean a $2,200 monthly housing budget instead of $3,300. That's a $310,000 house, not a $400,000 house. And that's okay, because you'll actually be able to live in it without checking your bank account before buying milk. Strategy 2. The 50% down payment shift. I know what you're thinking. Nobody has 20% down for a $400,000 house. That's $80,000. But here's the move. If you've saved $35,000 for a down payment, don't buy a $400,000 house with 9% down. Buy a $280,000 house with 12.5% down. Your mortgage drops to $245,000. Your monthly payment falls from $3,348 to $2,087. You just freed up $1,261 per month. That's $15,132 per year. That's retirement. That's savings. That's actually building wealth instead of just owning walls. Strategy 3. The delayed gratification compound. Every year you wait to buy while continuing to save, you're not just saving money, you're avoiding debt, building a bigger down payment, and letting home prices potentially stabilize or correct. If you're saving $1,500 per month while renting instead of buying, that's $18,000 per year. In 3 years, you've got $54,000 saved. Now you can put 15% down on a $360,000 house, avoid PMI entirely, and still have a lower monthly payment than buying today with less down.
Strategy 4. The market migration. $400,000 in Denver gets you a 1,200 square foot starter home. $400,000 in Pittsburgh gets you a 2,800 square foot house in a great school district. I'm not saying everyone can or should relocate, but if your career allows for remote work, or if you're early enough in your career to be flexible, geographic arbitrage is real. The same salary goes dramatically further in different markets. Look, I won't lie to you and say this is easy. This journey is unfair. It takes far more effort to build financial security now than it did for previous generations. The playing field isn't level. But you're not broken for feeling this way. You're seeing clearly. The question isn't whether you can get approved for a $400,000 house. The question is whether that house will actually improve your life or just transfer your income to a bank while you stress about property taxes. You're not failing at adulthood because you refuse to financially drown yourself for granite countertops. You're just doing math that apparently nobody else wants to do. The housing market will keep pretending these prices make sense. Banks will keep approving loans that shouldn't exist. Real estate agents will keep telling you it's a great time to buy. But you don't have to participate in collective financial insanity just because everyone else is. Sometimes the smartest move is recognizing when the game is rigged and choosing not to play, at least not on their terms. If this video changed how you think about homeownership, share it with someone who's about to make the biggest financial decision of their life. We don't talk about this stuff enough. Thanks for watching, and I'll see you in the next one.